itself into a different reality. The reality of the last 50 years has been capped by $50. And those were even isolated peaks. And it's not like you lived up there for very long. It was really days or, a couple of weeks. Most of silver's action's been in the $20, $30 range for 50 years, okay? So in real dollar terms, if you measured silver against the degradation of the money unit, it has been going down. In real dollar spendable terms per ounce. Minimum, you're going to see $100 in the next 6 months. And you quite likely could see $200 in the next 6 months.
Michael Oliver, a seasoned market analyst with decades of experience in commodities, presents a compelling case for an imminent silver breakout that could reshape the metals market. Drawing from historical patterns and technical analysis, Oliver emphasizes that silver is on the verge of breaking key resistance levels relative to gold, which historically signals a phase of accelerated price gains. According to his research, this breakout could trigger a rapid and substantial rally, similar to those witnessed during the early 1980s and the 2010 to 2011 period, when silver's price skyrocketed in just a few months. Oliver points out that silver's unique behavior in relation to gold is a critical factor to watch. Historically, silver tends to lag behind gold at the start of major moves, only to outperform significantly once momentum shifts. This relationship is best observed through the silver-to-gold price ratio, which, when it crosses specific thresholds, has often foreshadowed explosive gains in silver's price. Oliver's interpretation of these technical signals suggests that we are approaching such a threshold, indicating a strong potential for silver to lead the metals complex higher in the near term. One of the key drivers behind Oliver's bullish outlook is silver's prolonged undervaluation compared to gold and inflation. Unlike gold, which has enjoyed sustained attention from investors as a store of value, silver has remained relatively depressed, creating what he calls an asymmetric opportunity. This undervaluation means that silver has more room to appreciate, especially if the broader monetary environment continues to favor precious metals. Oliver believes this imbalance will ultimately correct, resulting in silver's price catching up sharply to its historical norms and beyond. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
50 years of silver price, okay? It's plotted on a ratio scale. So in other words, a move from 10 to 100 is the same as going from 100 to 1,000 in terms of multiple gain. And this is silver. And you can see the surge back in 1980. When you go to YouTube and see it visually, you'll see we've got an arrow that spans the last couple of quarters of that multi-year move. Remember, it started in the summer of 76 and went up to 1980. But in the last 2 quarters of that bull market, silver went from $8 to 50, compressed in the last handful of months, okay, and peaked. Okay, so we've marked the dimension of that move in the last couple quarters of that bull trend with this red arrow showing the size of it on a log scale. Then we go back to the next bull market, which was in 2010 and 11, when silver went from, it had been going up for a couple of years, quite a few years since the early 2000s, just like gold. And then so it was an aged bull market. But then all of a sudden in 2010, something happened, and I'll explain what that is later. And the price of silver went vertical for the next couple quarters, from like, the 17, $18 to 50, all compressed in the final handful of months of what had been a decade-long bull trend. Most of the move occurring in the last couple quarters. What caused that? Okay. And then I show the current bull market, which again started, back in 2015. Silver wallowed around while gold advanced and went sideways, $15 to $30 and so forth. We went up into 2021, got up to 30. Then we went into a range again for 3 or 4 years where silver just was stuck with a cap at about 30, making higher lows then in the pullback. It got down into the 20s again, I think. And then in 2024, we emerged above that 30 level and started to advance, but still not an explosion, just, a persistent process. I think we're at the cusp now of that accelerated phase, where in the final 6 months of the move, silver prices itself into a different reality. The reality of the last 50 years has been capped by $50. And those were even isolated peaks. And it's not like you lived up there for very long. It was really days or, a couple of weeks. Most of silver's action's been in the $20, $30 range for 50 years. Okay. So in real dollar terms, if you measured silver against the degradation of the money unit, it has been going down, in real dollar spendable terms per ounce. And I think we're about to launch not only through those dual highs at $50 that everybody knows. That's not technically significant to us. That's a price level that is a relic, really, because you're talking 1980 at $50. Heck, in real dollar terms, silver would probably have to be over $200 right now just to match the 1980 high in spendable real terms, okay? And even the 2011 high at $50, we'd probably have to be well over 100. But anyway, I think we're about to launch that handful of months acceleration that drops jaws and is, frankly, to be expected. Where silver says, I've had enough, you've made an error, I've been depressed for too long on a relative basis to gold and a relative basis to a lot of things. I'm going to catch up, and I'm going to do it so fast, if you're not there, you're going to miss it. Yeah, you'll make a high, but I suspect that high is going to be so much higher than we are now that if you're fearful of the correction that comes after that high, you're going to miss the move. Now, gold, while it's been going up with gold in price, has been degrading, especially since that 2020 surge where silver beat gold. Silver then got up to 1.5 something percent the price of gold, still fairly low, but retreated all the way back down under 1% again at that recent low in April. Since April, it's surged from 0.9 something percent to 1.2%. And when you look at the spread chart, you're already starting to break out above a downtrend on that spread, but there's a ceiling where if you go back to 2022 and 2024, that spread reached a certain level around 1.31%. Don't get worried about the details there, but
the red line.
Yeah, there's a red line on the spread where there's a horizontal line, meaning if you go back there a third time, you're at a, quote, triple top. Don't count it stopping, okay. But we also run momentum of the spread, just like we run momentum of price. And when you run a momentum chart of that spread, you see a slightly different picture. One, you're challenging right now that ceiling on momentum. The spread, again, is at 1.2, and it needs to get to 1.31 to be there. Okay, so it's not quite there. But the momentum of the spread is, as of last month, and today it may, with today's action, might even be nudging above that. Momentum of the spread is breaking out. Now, that indicates to us that silver's about to shift into a strong outperform relationship to gold. So as gold continues up, silver will go up more on a percent basis, be the better place to be, just like it was in 79 to 80 or 2010 to 11. In the tail end part of those bull markets, silver went berserk relative to gold. And at no time in history, when this spread turns favoring silver, does it mean downside in price of gold more than silver? It always means upside of price of silver more than gold. So it's always not just favoring silver, but it's also saying the price of both metals is going to go up, except silver is going to beat it. We're on the cusp of that. Now, why is that important? It is the exact same spread situation occurred prior to those 5 to 6 months surge late in 79 to 80 and October 2010 to April 2011 on silver, where silver's price went off the page upside relative to gold, but it was pre-signaled by this spread breaking out. We're exactly there now. on this spread. It's telling us that not only are both metals continuing up, but we're at the point now where silver could go vertical. And then the issue becomes, well, what's vertical? Take out 50, yeah, a lot of people are going to be impressed. That's really a minor indicator to us. We're right now just below 48 as we speak today. Okay. The spread says that when you break that spread out, and again, let's assume this month does it. We're intra-month, we're doing it right now. And you break the spread out, not just the momentum of the spread, but the spread gets up to the 1.3 something percent. You could easily go to 2% in a heartbeat. Well, that's a huge move. Yeah, when you go from 1.3 to 2, that's not a doubling, but that's, it's huge. And it's like buying a stock at 130 and it goes to 200 quickly, okay? But right. I don't think you'll stop at 2% because in bull trends, the silver spread always goes to at least 3, meaning we could be at a position now where if this spread breaks out, not only is silver going up more than gold, but it's going to double in value to gold over a handful of months. So not only an outperformer, but a vast outperformer. And it also will convert into a vertical net price gain in the monetary metals, where what you've seen recently in gold and silver is nothing compared to what you're about to see when this spread breaks out. And I think we're on the cusp of it right now.
Supply constraints also play a crucial role in Oliver's forecast. He highlights the fact that silver production is largely dependent on mining byproducts from other metals, such as copper and lead, which limits the ability to ramp up supply in response to rising prices. This structural supply limitation, combined with increasing industrial and investment demand, sets the stage for a supply-demand imbalance that could fuel significant price inflation. Oliver suggests that unlike other commodities, silver's supply dynamics will amplify price moves rather than moderate them. Furthermore, Oliver stresses the broader implications of a silver price surge beyond just the metals market. He argues that a major breakout in silver would represent not only a price correction but also a fundamental repricing of silver's role within the global monetary and economic system. Given silver's dual function as both an industrial metal and a monetary asset, such a move could have far-reaching effects on inflation expectations, currency valuations, and investor portfolios. Oliver's analysis thus positions silver as a key asset to watch in the context of macroeconomic trends.
The background factor as well, but our focus right now is on this trigger point because in the past, when you look at those two parabolic moves, it's what caused that? Okay, what technical signal? Because already silver was in an uptrend, so it's not like it started a bull market. Then it had already been in a bull market. What caused it to accelerate is the key, and we think it was this spread relationship caused the flow of money to go into silver because when it broke out, it woke people up, especially people on the industry side. But silver right now is vastly undervalued historically to where its normal price is, even in a commonplace year. Like I said, 21 of the last 50 years, it's been at least 2%. Didn't even require a bull market most of those times for it to be there. We're at 1.2. Okay, so wake up. You've got a situation here that is pending, and it looks like it's explosive. And it will happen not slowly, but it'll unfold so quickly. Now, you've got to also be aware that in the middle of both of those moves, where we've been up like 5-6 months vertically, there was a 1 month phenomenon of a correction that fooled people. So like after about 3 months of upside gush, you get this month that says, oh golly, I made a top, okay? Don't count on it. Now also there's another issue. Well, where might silver go? When we do a study of the logarithmic percent gain, once that spread broke out, where was silver then? What percent did it gain over that next 6 months? Well, it was different. 79 to 80 was far more on a percent basis than it was in October 2010 to April 2011. But they were both very dramatic, obviously. If we then take those logarithmic moves not point value, not dollar value, but the percent scale move of each of those swings post the breakout in the spread. How much did silver gain? And you lay them on top of the current chart. It argues minimum you're going to see $100 in the next 6 months. And you quite likely could see $200 in the next 6 months. The issue will be, in my view, where are you in that first half of that surge? In other words, if it takes us 3 months just to get up to, let's say, $70 or so, and then you have a correction, then maybe in the next 3 you only go to 100. But if all of a sudden we find that in 3 months, the first half of that move, you reach somewhere around 100, then watch out. There's a potential we could go to a couple hundred. And by the way, in real dollar terms, as I've said, based on the degradation in the money unit, if silver were 200, it'd merely be matching something like that 1980 peak. So, ponder on that.
Yeah.
I think we're sitting on a unique situation here.
You give me a lot to ponder about here, Mike. That was about loss for words.
Yeah.
Is there anything else?
You go to the next page, and I'll show you. I'll show you the chart.
Perfect.
Here's the 2008 move, for example. Spread chart is the top one, and it shows the same ceiling type action that prevailed for a couple of years, just like ours has prevailed since 2022, 2023, 2024. The highs were all at that 1.31%. Well, back then it was a different level. It was like 1.6%. So, but there was a ceiling on the spread, the top chart. And we've circled the green point where the months that broke through that ceiling on the spread relationship between gold and silver. And it's at that point where price went vertical. And then below it, we've posted the monthly price chart of silver and the monthly price chart of gold at that point where the spread broke out. And gold then was like 1,300. And then, by the next 6 months, it reached up to about 1,580 or so. Nice move. But silver went from 20-something dollars to 50. Far more vertical. Ultimately, gold went up to 1,900, but that was a more laborious part of the move. But in the next 6 months, silver left the page and gold continued up nicely. But that spread announced the point of the rocket launch in silver. I think we're at the same point now where silver back then, between 2008 and 2010, had been going up nicely. It went from, $9 up to 20-something. Nice percent move. But it was laborious. It ceased to be laborious when that spread broke out. Silver just took off like a rocket. And therefore, we're highly focused on what that spread is doing, because that was the signal indicator in 79 and 2010 that silver's going to go berserk. Right now, a lot of people are looking at gold and think, well, gold's going ridiculously. It's look at the huge amount of dollars up. But actually, in net terms, it's still not, it's approaching halfway of what happened in 79 to 80 and what happened in the 2000 to 2011 bull market. They were both 8-fold gains from prior bear low to prior bull high. And ultimately, late in the move, you understood why. Oh, yeah, okay, now I understand. First, an asset class movement out of a degrading asset that had been bubbled, and it broke. The money went somewhere, usually went into T-bonds or gold, or both. This time, it's primarily gone into gold. T-bonds have been in a lateral range for 3 years. And that's its primary driver, and we're not even close to the metrics, the dimensionality of those moves. So people who are arguing, they're looking at a price chart, oh my gosh, this is too much, too fast. You're looking at dollar terms, look at percent gain. Gold has to go to $8,500 to match the percent gain that it had in the 1980 peak versus its 1976 low, or from its 2001 low to its 2011 high, 8-fold move. We'd have to go to 8,050 because our bear market low was 1,050. Okay? So we're not even started in terms of catching up to those. And I think a lot of people miss that. And the reason is those basic long-term underlying asset flows. The Fed creates degradation of money, the money goes somewhere. And when they accelerate the degradation of money and the investors finally decide, I'm not going to keep playing the game we've been playing because I perceive risk, stock market, they move it somewhere. And I think that the place they're going to move it now, more so, is into gold and silver, but also into basic commodities. Commodities are vastly underpriced historically to themselves and to other asset categories. Like the Bloomberg right now is around 104 or 5. Its high in 2008 was 237. Okay, so we're not even halfway to it. So anyway, this is the main driver. It's not so much a specific thing. It's the broad context. And yes, some of these specific things help explain that. And right now, certainly the stock market doesn't care about, quote, economics. It cares about, a bad number, bad economy, great, Fed's going to print. Well, that drugged out game historically never continues. There's a point at which it finally breaks on its own. I think we're there. Our technicals say do not trust this stock market. A new high by 10% by the S&P over the January high. You wobble back down a few more percent points, you're going to go back through that high. And then people will say, I thought we had a breakout. And that's when the panic's going to hit. Meaning the people in the stock market who felt comfy will suddenly feel uncomfy. And they'll go to where, it's comfort.
Yeah. We're gonna go over that. One last question before we go to the charts here.
Several key factors underpin this optimistic price forecast. First, silver's long period of relative stagnation compared to gold and inflation suggests a significant catch-up effect is overdue. The metal's historical tendency to outperform gold once momentum shifts supports this view. Second, supply-side constraints, driven by the fact that a large portion of silver is produced as a byproduct in other mining operations, limit the potential for quick increases in output, even as prices rise. This supply inelasticity, paired with growing industrial demand and investor interest, creates a potent supply-demand imbalance that can rapidly drive prices higher. Oliver also emphasizes that the anticipated price surge in silver is not just a matter of commodity market speculation, but is deeply intertwined with broader monetary trends. As inflation concerns persist and central banks grapple with complex economic pressures, silver's dual role as both an industrial metal and a store of value becomes increasingly relevant. A sharp rise in silver's price could reflect a broader repricing of precious metals as hedge assets against inflation, currency devaluation, and economic uncertainty. This dynamic could attract a wider array of investors, further fueling upward price momentum. Do you think silver is finally on the verge of a historic breakout, or will it remain one of the most undervalued assets in the market? If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.